Welcome back to the deep dive. We're doing something a little different today. Usually when we talk about, the future of technology, everyone's eyes go straight to the screens, the chat bots, the software, the AI that writes poetry.
It's the shiny stuff. It always grabs the headlines.
Uh,
And the venture capital.
Exactly. But today, we're looking at the thing that makes all that shiny stuff possible, the invisible layer. Because while everyone is obsessed with chip makers, there is this huge bottleneck forming that very few people seem to be talking about.
Right.
It isn't code, it's electricity, specifically the grid itself.
It's the physical world finally checking in on the digital dream. You just can't run a 2025 data center on a grid that was built in, 1975.
And that brings us to the subject of today's deep dive, Astor Energy, or Astor Energy. We've got their 2025 annual report right here, the Fayed Raparu, and looking through it, Astor isn't just a local Turkish manufacturer anymore.
No, it seems like they're positioning themselves as a really critical infrastructure player for this whole global energy crunch.
That's the core question we need to explore, right? Are they just a factory in Ankara, or are they becoming a strategic partner for the global AI boom?
Because the valuation, the stock price, it suggests the second one. But we need to see if the actual operations back that story up.
So our mission today is pretty simple. We need to figure out if Astor is building a sustainable fortress, or if they're just, riding a temporary wave. Especially for you, the retail investor, looking at this from the outside.
And before we plug in the standard disclaimer, we are analyzing the 2025 activity report for educational purposes only. This is not investment advice. We're exploring the data.
But you need to do your own homework.
Absolutely.
Okay, let's first get to know the company a little. For someone who hears Astor Energy and maybe thinks they sell, I don't know, solar panels or something, what are we actually looking at here?
At its heart, Astor makes transformers. And to understand why that matters, think of the electric grid like a massive interstate highway system.
Okay, I can picture that.
The electricity moving on those main lines, the high voltage lines, it's traveling at an incredible speed and pressure. It is way, way too powerful for a toaster or server rack.
Right. You can just plug your house into that.
It would fry everything instantly. So you need an off-ramp.
And that's Astor.
Precisely.
Yeah.
Astor builds the off-ramps and the on-ramps. They make the smaller distribution transformers, which step the power down for local neighborhoods or factories. And then they make these massive power transformers, which handle the heavy lifting for the grid itself.
And the report also mentions switching products. What are those?
Right, high voltage switching products. Think of those as the traffic lights and the safety valves of the whole system. If something goes wrong, a lightning strike or a surge, these switches cut the power so the whole grid doesn't just melt down.
Unglamorous, but critical stuff.
Absolutely critical.
And they're doing all of this from where?
Ankara, Turkey. Specifically, the Sincan Organized Industrial Zone. And this is not a small shop. We're talking about a facility that's 140,000 square meters.
Give me a sense of scale for that. What is that like?
Imagine about 20 soccer fields of heavy industrial machinery, all under one roof. By the end of 2025, they had grown to almost 2,500 employees, 2,478 to be exact.
Wow, and that's a 19% headcount increase in just 1 year?
It is. For a manufacturing firm, that's huge growth. It really implies they're gearing up for something big.
I also noticed in the report they made a point to highlight their diversity stats. Is that just corporate fluff, or is there something real there?
It's becoming a standard metric, for industrial firms who want foreign investment. So total female workforce participation is around 13%, which sounds low.
Yeah.
But if you look just at the white-collar roles, so engineers, management, it's over 30%. It suggests they're really modernizing their management structure, even if the factory floor is still, male-dominated.
Let's talk ownership. Who's actually steering the ship? Because looking at this, the shareholding structure seems, concentrated.
This is crucial for the learner to understand. The majority owner is Feridun Gejal, and he holds both A Group and B Group shares.
Break that down for us. Why do we care about A and B groups?
It's all about control. The A Group shares have special privileges. They get to nominate board members, and critically, they carry 5 votes per share.
5 votes. And the ones I would buy in the market.
Those are B Group shares. They only get 1 vote.
So the public has about 37% of the company, but realistically, Feridun Gejal calls all the shots.
Exactly. You are a passenger on his bus, you own a ticket, sure, but you are not grabbing the steering wheel. Which, look, isn't always a bad thing. Founder-led companies can be great, but it is a risk you have to accept.
You can't vote him out.
No.
So let's zoom out to the road ahead. We started this by talking about AI. How does a transformer company in Ankara actually connect to ChatGPT in California?
It connects through the megatrend of electrification. Global electricity demand is just skyrocketing. It used to be about turning on lights. Now you've got EVs drawing huge power, industries switching from gas to electric, and then the 800-pound gorilla in the room.
Data centers.
Data centers. I mean, I read that a single AI query uses something like 10 times the electricity of a normal Google search.
At least. And those centers need massive, totally reliable power, 247. But here's the real kicker. The US and Europe are trying to power this 21st century tech on grids built in the 20th century.
It's that aging infrastructure problem we always hear about.
It's ancient. In the US, transformers are failing faster than they can be replaced. There is a global supply crunch. Lead times, the time between ordering one and getting it delivered have stretched to months, sometimes years, which Economics 101 means the manufacturers get pricing power. If I need a transformer for my billion-dollar data center, I'm not going to haggle over the price of the plug.
You'd think so. And that is where Astor is positioned. They've climbed to number 74 on the ISO 500 list in Turkey. They are trying to be the ones selling shovels in this new gold rush.
But let's play devil's advocate for a second. If I'm a U.S. utility, why am I buying from Astor in Turkey? Why not just buy from Siemens or GE or someone local?
Availability and integration. The big legacy players are booked solid. And Astor has this competitive advantage they call integrated production. They actually make their own mechanical parts. They don't just assemble things, they fabricate them.
So they can move faster.
They can move faster than competitors who are stuck waiting on parts from someone else. Speed is their weapon.
Okay, that makes sense. Let's look at their strategy then. Now let's take a closer look at what management is telling us. I went through the CEO and CFO messages in the report. It felt, well, ambitious.
It's a huge strategic pivot. They're trying to shift from being just a vendor, someone who sells a product, to becoming a strategic partner. And the headline number that proves this is the U.S. expansion.
$123 million.
That's the figure. By the end of 2025, they had signed contracts worth 123 million USD with U.S. companies.
And is that a lot for them? I mean, in context?
It is massive. Entering the U.S. energy market is incredibly difficult. You have regulatory hurdles, UL standards, and just general skepticism of foreign hardware in critical infrastructure. So to clear $123 million in contracts, that's a proof of concept. It shows they've cracked the code.
And it's not just where they're selling, it's how they're building. I kept seeing the phrase vertical integration. They're building a factory to make their own wire.
This is their phase 2 investment, a whole new facility to produce insulated copper and aluminum conductors.
Help me out here. Why go through all that trouble? Why not just buy the wire like everyone else does?
Think of it like a bakery. You can buy your flour from the supermarket and you pay retail price. And if the supermarket runs out, you can't bake any bread. Or you can buy the wheat field and grind your own flour.
So they capture the profit margin that the wire supplier used to make.
Exactly. Copper and aluminum are their biggest costs. If they make the wire themselves, they lower their costs. And, crucially, they control their own supply. They expect to produce 12,000 tons of this stuff annually. It's a strategic moat.
They also did some house cleaning in 2025. Sold off a company called Astor, spinning off their EV charging network. Astor Charge? What's that about?
Focus. Pure focus. Astor was a power generation business. Astor Charge is a service business. By getting rid of them, they're telling investors, we are a manufacturing company. We build heavy machinery. That's it. It just cleans up the balance sheet and makes the story simpler.
Speaking of the story, let's look at these phases they talk about. We mentioned phase 2, the wire factory, but they also teased phase 3 and 4.
This is the future growth engine. In January 2026, so right after this report closed, they announced a new high-power transformer factory and a new mechanical factory.
High power, so the really big units.
The giants, and there's a very specific reason for this. In 2025, Astor had a problem. The market for the smaller distribution transformers, the neighborhood ones, it got crowded.
A price war.
A mini one, yeah. Prices for domestic distribution transformers in Turkey dropped about 22%.
Ouch. That eats into your margins fast.
It does. So even though they increased production capacity by 17%, the revenue didn't scale perfectly because the price per unit dropped. This whole pivot to high-power transformers is a way to escape that. There are fewer companies that can build those massive units.
So the margins are fatter And the competition is thinner,
That's the idea. And they're spending a fortune on R&D to get there. Over 1 billion Turkish lira.
which is what, about 27 million US dollars?
Roughly. Which for a Turkish manufacturing company is a serious commitment. They're not just bending metal, they're engineering custom solutions.
Okay, but we have to take off the rose-colored glasses. It's not all growth and expansion. There's a legal elephant in the room here.
The litigation. The Turkish Competition Board, the Rekabet Kurumu,
They got fined. Big time.
they did. Roughly 340 million TL. That's about 9.3 million US dollars.
That stings. What was the charge?
Antitrust violations, basically anti-competitive behavior. Now, to be fair, Astor has set aside a provision for this. They're planning to pay it to get a 25% discount, and then they're going to appeal.
But for an investor, that's still cash that isn't going into a new factory.
Correct. It's a hit.
Yeah.
And that's not the only risk. There's also the execution risk we touched on.
The deferred growth.
Right. Management admitted they missed some 2025 targets because of investment delays. If you're betting on Astor, you're betting they can finish these Phase 3 and 4 factories on time. Construction delays mean lost revenue.
Let's briefly touch on corporate governance. Sounds dry, I know, but for an emerging market company, it really matters.
It matters a lot for international credibility. Two things stood out to me. First, they switched their entire company software, their ERP system, to SAP S/4HANA.
Translate that for me. Why does a software upgrade matter to an investor?
SAT is the gold standard. When a company does this, it means they are locking down their data. It implies way better transparency. You know where every single kilogram of copper is in real time? It suggests they're preparing for the scrutiny that comes with being a global player.
And what about this Quality program?
It's a state-sponsored branding program in Turkey. Being accepted means the government basically stamps you as a global brand candidate and helps with marketing. It's a vote of confidence from the state.
All right, let's get to the part everyone's waiting for, the financials. We've converted these to US dollars at about 36.5 lira to the dollar to make it a bit easier.
Okay, top line first. Revenue. They brought in 35.3 billion TL. That's approximately 967 million US dollars.
I'm the growth rate.
This is where the record scratches. Year-over-year growth was only 1.3%.
Wait, 1.3%. We just spent 10 minutes talking about the AI boom, the energy crisis, insatiable demand. How is revenue basically flat?
It's that disconnect between volume and price. Remember that 22% price drop in the smaller transformers? They sold more units, but because the price per unit collapsed in their domestic market, the total revenue just barely moved.
That feels like a red flag, doesn't it? Like
Yeah.
they're running faster just to stay in the same place.
It's a concern, and it shows exactly why that pivot to the U.S. and to high-power units is so urgent. They can't grow by selling small transformers in Turkey anymore.
But, and this is the twist that confused me, their profitability actually went up.
It did. Net profit was 7.7 billion TL, so about 210 million USD. And the net margin rose to 21.7%, up from 18.9% the year before.
So flat sales, higher profits. How did they pull that off?
They made money from money. There was a huge jump in investment activity income. It went up 162%.
Explain what that means for the learner.
This isn't money from selling a transformer. This is money from interest, from managing their cash pile, from financial investments.
So the core business was flat, but their CFO was really good at investing the company's savings.
Essentially, yes. And while that keeps the bottom line looking healthy, investors usually prefer quality of earnings. You want the profit to come from operations, not the bank account.
There is one other number here, though, that I think kind of saves the day. The export ratio.
This is the aha moment of the entire report. In 2025, foreign sales jumped to account for 60% of their total sales.
And it used to be less than 40%, right?
Yes. In just 1 year, they completely flipped their revenue mix. They are now bringing in the majority of their money in hard currency, dollars and euros, instead of Turkish lira.
Which is a massive hedge against inflation in Turkey.
It's the ultimate safety net. It proves that the global expansion isn't just a PowerPoint slide. It's actually happening. It's in the bank account.
And what about the balance sheet? Are they drowning in debt to build all these new factories?
Surprisingly, no. Total assets are about 1.4 billion USD. Their equity is 66% of total assets.
That seems pretty conservative.
It's very healthy. They're funding this huge growth mostly with their own cash flow. They aren't leveraging themselves to the moon.
So let's try to pull all this together. We've got a company with flat revenue but rising profits, a huge, successful pivot to the U.S. market, but major execution risks with new factories.
It's a company in transition. They're trying to graduate from being a regional manufacturer to a global infrastructure player.
Okay, What are the key takeaways for the learner? If you have to remember three things from this report, what are they?
First, the strategic proof. They successfully broke into the U.S. market. That $123 million in contracts validates their product. The door is open.
Okay, number two.
Vertical integration. Making their own wire is a long-term defensive move. It will protect their margins and secure their supply chain. It's a really smart play.
And the third?
The currency hedge. Moving to 60% exports protects them from the volatility of their local economy. They've really decoupled their destiny from local market conditions.
And the risks we need to watch.
Well, the fine is a one-time hit, but the real risk is the construction clock. Can they build Phase 3 and Phase 4 on time? If they get delayed, that flat revenue growth might stick around, and investors could lose patience.
They need to turn that concrete into cash flow fast.
Exactly.
All right, here's where I want to leave our listener with a final provocative thought.
Go for it.
We started this by talking about AI. Astor is clearly betting the house. They're literally pouring concrete for new factories on the idea that demand for power transformers is going to keep exploding.
They are long on electricity.
But what if the AI hype cycle cools down? What if data center construction pauses for a bit because the models aren't making enough money yet? Does Astor's order book just dry up?
That is the risk. But the alternative view is the grid in the West so incredibly old, so crumbling, that the demand is guaranteed regardless of whether ChatGPT needs more power or not?
And that's the multi-million-dollar question, isn't it? Is Astor an AI play, or is it just a keeping the lights on play?
I lean toward necessity. You can turn off a chatbot. You can't turn off the grid. But the market often trades on the hype.
A fascinating spot to be in. Well, that wraps up our deep dive into the Astor Energy 2025 annual report.
A lot of moving parts in this one, a real transition story.
Definitely. And just a reminder to everyone listening, we are just two people who love reading 100-page PDF reports, so you don't have to. This is not financial advice.
Please do your own research.
If you enjoyed this deep dive, please hit that like button, subscribe, and share it with a friend who's obsessed with the energy grid. And if you really want to support us, check out the Super Thanks feature.
We really appreciate all the support.
Thanks for listening, and we'll catch you on the next deep dive. Goodbye.
Goodbye.